Hi, it's Dre Griggs with Obsidian Wisdom. Today we answer the question, what are 10 buy and hold forever dividend stocks? When it comes to dividend stocks, when it comes to really any stocks, the idea that we can buy and hold something forever was made popular by Warren Buffett. He talks about finding incredible companies at a discount, buying them with the plan to hold them forever, which is not the same as saying, I guarantee that you'll be able to buy and hold something forever. I will give you in this video about 4 barometers that I use when looking at stocks to determine whether they are a good investment, a good long-term buy and hold investment. Now, that doesn't mean that it's always the case, but what I will say is if you always buy dividend stocks that have these metrics where you stick to your disciplined investment strategy, you increase the likelihood of making sure that you actually make the money that you're looking to over the long term. We're not over here speculating. I'm not going to go with whatever the clickbait stock is. I'm going to tell you the investment strategy I'm using, why I chose these companies, and then you can invest and decide whether that makes sense for you. So this list of the 10 buy and hold stocks that I'm going to give you, they have a few things in common as far as why I chose them. So number one, these companies were chosen because they've had considerable 5-year annual compounded percentage growth increases in their dividends from 2008 to the current 12-month indicated rate. So I'm looking over a long period of time. 5 years is a good barometer, at least as far as the minimum. Sometimes I go up to 10 years if I don't understand the company or I haven't really been hearing anything about them. But 5 years is a pretty good spot. With that said, if someone has a weird year where, let's say it's like COVID, I'm probably going to give them a pass on COVID because everybody was having a rough time. But if they did well over that period of time as well, that's just another good reason to invest in the company. So they also have increased their dividend payment each year from 2018 to the current 12-month rate. So you're also going to see that with these 10 investments. And then they have a 2024 dividend coverage rate of at least 1.5%. Now, there's different ways that you can measure whether a company is doing well. As far as the dividend coverage rate, that's taking the 12-month earnings and you divide that by the current dividend rate. If you have at least 1.5%, that is normally a good sign of a healthy company to invest in. You don't want to fall into a dividend trap where there's some sketchy companies that are just promising a large dividend and they don't have any ability to make that payment over a long period of time. So if you have a dividend coverage rate of at least 1.5%, a 2024 estimated PE, that's the price per earnings ratio, of less than 20. So as far as the value investing, we're not overpaying for something. We're not trying to find the next hot thing. We want to find consistent, good, solid investments that will be around over a long period of time. So they have a 2024 estimated PE ratio of at least 20. And then they have an increase in 2023 and 2024 earnings per share and at least a 2% yield. Now, if you take these metrics, you will find that you're going to be in a pretty good spot. And so these companies I'm going to list for you, the 10 that I'll give you today, have all of these boxes checked off, where it puts you in a position to be able to buy and hold these companies over a very long period of time. Now, forever, I don't know, because as the market changes, adaptations happen. For example, there was a point in time where information wasn't readily available. So hedge funds made a ton more money than they do today because there's so much information that's already available, where you had to call a brokerage firm and you had to have a broker to enact each of your trades. Well, today you can have a trade executed on your phone anytime you want. As technology changes, as consumer sentiment changes, as these companies grow and change, as the society as a whole, where AI is going to create jobs and it's going to end jobs. And this happened with automation, with robotics, with globalization. As the economy shifts, it is going to impact all of our investments. And so all we can do is put a disciplined approach in place. And if our disciplined approach, as long as we maintain these metrics, where if a company checks off these boxes, then they stay in our dividend strategy. And if for some reason something happens and they start to fall out in the metrics, that's up for you to decide. Am I going to get rid of them if one of these metrics they lose, or will I wait a little bit, maybe 2 of them? Anything that you want to decide, that's really up for you. But the first one is Sprott Inc. And so that's SII. You'll see that they have a 2024 estimated earnings per share of 2.1. They have a PE ratio estimated of 2024 at 16.07. and then you will see that it has a dividend growth rate of 69.6% and a yield of 3%. So if based off these metrics, it is still at a really good value looking at the PE projected ratio, and we have a 3% yield and a really good dividend growth rate. So this company is going in the right direction. MVB Financial Corp, so that's SVBF. You see that they have a 2.5 for their earnings per share, and you see they have a 2.7 yield. We have Solaris Oilfield, and then that's SOI, that's a 1.7. You see the PE is at 6.48. And so the PE, this is a great value if you're looking at the PE ratio. Naturally, we look at more than that. That's why we have so many other metrics to look at this. We don't want to fall into value traps, and we don't want to fall into dividend traps. The truth is, there's a bunch of traps that if people know what you're looking for when you are looking to invest in something, they can make their numbers look exactly how you want them to look, and that becomes ugly. So the reason we have multiple metrics is because it gives us the best chance to be able to buy and hold something, but it doesn't mean that you genuinely don't have to look at it in 20 years. I would at least consider looking at all my investments once a year. I would consider that a very passive approach where it's almost buying and holding forever, but at least just take a look. We're not trying to find the investment that is going to be hot today and then we have to get rid of it over the next couple weeks or the next couple months. But at least if you're able to just take a look at your investments once a year, just see how they're doing. Do they still have these metrics that we're looking for in our dividend investment strategy? I told you the third one was Solaris, that's OSI. You can see GoEasy Ltd. You can see Barrick Gold Corp. You can see Virtus Investment Partners. You see the Jamieson Wellness Inc. That is the WJLLF. You can see that its price currently, and that's what we have in this corner over here. So you can see the price for the Jamieson is $23.33 currently. And then you can see the Piper Sandler, that's the PIPR, has an estimated earnings per share of 13. It has a PE ratio of 11.28, right? That's a really good earnings per share. And then you also can see that your yield is at 2.5%, and then the dividend growth rate was over 20%. So the dividend that they paid year over year over a span of 5 years has increased by over 20. And that is a good, healthy outlook for a company. You can see Blackstone, not to be confused with BlackRock, and then Caledonia Mining Corp. You can see that they round off our top 10. They have a dividend growth rate of 19.5%, and then the price is around $12. And then you can see that the yield is 4.8%. So again, you can see within these top 10 investments, when we're looking at our long-term investment strategy or buy and hold for dividends, the top 10 that we currently see, based on the way the market is today, where it has a very nice PE ratio, has a very nice growth of the dividend stock, it has a very nice yield, the price is attractive, to where we're not chasing the next hottest fad. These are very solid, stable companies that have been performing well over the last 5 years. You would take a look at these, and then you can invest in these, decide if it makes the most sense for you with your investment strategy. If you like the video, I ask you to like and subscribe, and feel free to check out other Wisdometric videos if you're looking for ways to eradicate financial stress, generate passive income, and build a prosperous retirement strategy.